Well, folks, it's your host, Dean Curnutt, back with a narrated by me edition of the Alpha Exchange. As many of you may know, I've been hard at work bringing together the Macro Minds 2023 Charitable Investment Symposium. We held it on June 7th at the beautiful Times Center in New York City. The air quality was poor, but the content and overall discussions were beyond exceptional. We had more than 225 engaged attendees across the buy-side, sell-side, and allocator community as we gathered to collaborate and support our three beneficiaries. I want to again thank all of our speakers and sponsors. With your generosity, we raised $430,000, and that brings our three-year total money raised to just under $1.4 million. We've now supported 9 causes focused on student education. As I queue up some new guests for the podcast, I wanted to share some reflections on option pricing and modeling. I'm a big fan of anniversaries, especially when it comes to market events of consequence. In fact, one of our panels at Macro Minds was titled LTCM 25 Years Later, Risk Management Through Crisis Periods. Here we featured LibreMax founder Greg Libman and Black Maple founder Rob Bernard. Greg is, of course, well known for being among the few that capitalized on the housing crash and the GFC. Played by Ryan Gosling in the Big Short movie, Greg gives me hope that were they to make a movie about financial podcasters, maybe I could be played by an equally handsome gent. But I do digress. If LTCM is 25 years ago, it's also notable that 25 years preceding the summer of 1998, 2 other events of great consequence for markets occurred. In 1973, Fisher Black and Myron Scholes would publish their groundbreaking paper, The Pricing of Options and Corporate Liabilities. And that same year, the CBOE was launched, enabling the trading of single stock options. From a New York Times article dated April 26, 1973, quote, trading in 16 issues began this morning. AT&T, Xerox, Kodak, McDonald's, and a dozen others. This trading does not involve dealings in actual securities, but rather in the rights to buy them in blocks of 100 shares at a fixed price during a specified period of time, either 3, 6, or 9 months. The first trade to cross the CBOE tape today was an option for July Xerox. It was an option to buy 100 shares of Xerox at $160 each at any time between today and at the end of July. Xerox closed at $149, down a half on the New York Stock Exchange today. The Times article continues. The price of the Xerox option was $525. This means that the buyer paid $525 for the right to buy 100 shares of Xerox at $160 per share anytime through the last business day of July. If the buyer had bought 100 shares of Xerox today, he would have paid $14,900 for the stock. I looked at Bloomberg. I know what you're all wondering, what the vol was for this particular call option. My estimate is about 32 vol. Well, 50 years later, the U.S. listed options market is highly electronified, deeply liquid, and extremely active. In 2022, more than 10 billion contracts traded in the U.S. across the exchanges. The contribution of the Black Scholes model to the growth of the derivatives industry is difficult to understate. The pricing technology can be found in just about every corner of markets across the asset classes. Out of the formula pops a number, the implied volatility, that serves as a language for option market participants to communicate with. No model is perfect, to be sure. It was my University of Chicago professor, Nobel laureate winner Gene Fama, who said, quote, all models are false. By that, he simply meant that in the realm of asset pricing modeling, there are assumptions required that don't literally hold up in reality. That doesn't, however, prevent them from being extremely useful. And this is the subject of my short podcast, a look at the assumptions that make the Black Scholes model work and the degree to which these are consequential for option pricing and risk management. We might, in fact, subtitle this podcast, The Holes in Black Scholes, after a paper written by Fisher Black himself in 1989. Over the half hour that follows, I hope to shine some light on the implementation of the model by practitioners by way of exposing the manner in which the assumptions break down. We won't get too technical, but rather seek to uncover some intuition in thinking about option prices in a world that is encumbered by frictions not entertained in the Black Scholes framework. Let's first start with the breakthrough of the model. Their model tells us that under a certain set of assumptions, we can perfectly replicate the payoff of an option contract in all states of the world through a dynamic, self-financing trading strategy in the underlying asset. By identifying this replicating portfolio and then invoking the law of one price, Black and Scholes argue that the value of an option contract can be determined by the cost of the strategy required to mimic it. In an efficient market, identical assets must trade at the same price, even if they don't share the same name. So let's briefly run through the assumptions and then discuss which are important. First, let's say that while it's often referred to as a model, it's also a formula with an equal sign. The price of a call or put option can be computed exactly, again, under this strict set of assumptions. More on this later, but it's probably the case that the equal sign connotes a degree of precision that is generally alluring, sometimes seductive, and occasionally dangerous. To start, in the Black Scholes world, there is continuous trading. There are no transactions costs, there are uniform tax rates, and there is risk-free borrowing and lending. Right off the bat, we know this is not the world in which we live. Sure, trading on Robinhood may be nominally without cost, but trading costs, both explicit and implicit, are a real thing. Taxes are hardly uniform and can be especially tricky in the context of financial products. Over my 3 decades on Wall Street, I've always found derivative tax code experts an especially crafty bunch, and I am quite certain the Treasury is always a step behind them. Lastly, let's agree that risk-free borrowing and lending are not a thing in the real world. Last I checked, Jamie Dimon was taking my money in at JP Morgan near zero and lending it back out to me several percentage points higher. But these first 3 assumptions are all relatively harmless. Sure, they do matter. For example, when making a price on a high delta call option on a stock that has limited liquidity, a market maker needs to factor in the bid-offer friction that she will confront in implementing the underlying stock hedge. One's first line of defense in hedging an option is to assume a long or short position in the stock. Black Scholes doesn't contemplate this as an issue, though it can be. Interest rate differentials can matter as well. Sometimes a stock becomes hard to borrow in the stock lending market. If a market maker needs to short a stock in order to hedge a put option that he sold, this stock loan friction will add to the hedging cost and must be factored in. But it's the next 3 assumptions that matter most for the model and how it collides with market realities. First, stock returns are assumed to be normally distributed. This is the beautifully symmetric bell curve that has proven so useful in describing a broad array of distributions in the real world. Next, a stock is assumed to exhibit a known and constant variance. And third, trading is assumed to be continuous. With this set of assumptions, the Black and Scholes model is tied together by this wonderful acronym called LOOP, the law of one price. Even if their assumptions are rock solid, Black and Scholes still need the law of one price. An asset and its replicating portfolio must trade at the same price for the model and for markets to work. Put differently, there is no free money to be had at markets. To be clear, you are allowed to make money, but not without risking capital in the process. There are no opportunities for riskless arbitrage in the world of theoretical finance. As market participants, we argue all day long about the assumptions that underpin the model, about the reality that markets are not perfect, that there are trading frictions and business cycles, and that asset returns are actually not normally distributed, far from it. In the tidy world of Black Scholes, there is no debt ceiling or sovereign downgrade, no president with an errant tweet hurled at Kim Jong-un, no bank runs, no bubbles, no bailouts, no Brexit. There's no reflexivity or regulatory revamp, no crowding or collateral shortage or counterparty risk, no Minsky moments, meme episodes, or monetary mistakes. There are neither financial nor natural disasters. There are no special dates like elections, earnings, or economic data releases. In the Black Scholes world, the hedging protocol is robotic, uninterrupted, and uncontaminated by the outside world. In the real world, frictions abound. Let's discuss some of these frictions by way of some examples. First, some good news. The rule of 11 tells us that the next giant market crisis will not arrive until 2031. You've got 8 years to breathe easy. How do I know this? Well, let's start in 1987 with the biggest one-day market shock in our lifetimes, a 20% one-day down move in the SPX on October 19th. Add 11 years, and you've got to LTCM. Add another, and it's 2009 when the SPX has declined markedly from its previous high, and the Fed has gone all in on QE. Add another 11 years, and that gets us to March of 2020 and a new all-time high in the VIX. As I have now mentioned the oft-quoted fear gauge, it is time to recognize another anniversary, and that is the 30th birthday of the VIX. Created in 1993 as a simple construction of near-the-money one-month put and call implied volatility levels, the VIX is everywhere these days. Heck, there may be a Wheaties box approaching with the VIX on it to commemorate its third decade. Emerging from the Black Scholes model comes this concept of the implied volatility. With all of the model inputs directly observable, the stock and strike price, interest rate, and time to expiration, the missing link is the volatility input. The implied volatility forces the model to deliver the price we observe in the market at a given point in time. The study of implied vol does a good job of summarizing my career. What explains the time variation of implied volatility? How do we account for cross-sectional variations at a given point in time? If implied volatility is a driving force in changes in option prices, is there alpha to be generated in identifying factors that cause it to move up or down? This I have pursued for 3 decades. These and a host of other questions consume the time of professionals in the derivatives markets. In the Black Scholes world, the volatility of an asset is both known and constant. In this construct, the implied volatility of an at-the-money option would be the same as an out-of-the-money option. A very short-dated option would have the same implied volatility as a long-dated option. Across both strike price and time to expiration, we get a matrix of implied volatilities known as the volatility surface. In the neat world of Black Scholes, there is no such matrix, as each asset has a singular, well-defined implied volatility. In the real world, options traders are not indifferent to the strike price and time to expiration of the option. And this is what we will explore. First, let's introduce 2 terms that comprise the vocabulary used to describe implied volatility: the strike skew and the term structure. When we talk about the strike skew, we refer to the differential in implied volatility for an option of specific maturity across strike prices. For example, we might look at 3-month options on the S&P 500 and compare the implied volatility for a 10% out-of-the-money put, an at-the-money option, and a 10% out-of-the-money call. If the volatility surface is a matrix with strike prices across the rows, the term structure is formed through the different dates that comprise a column. Here we examine implied volatilities for a given strike price, but different expiration dates. For example, we might compare at-the-money implied volatility for a 1-month option, and at-the-money implied volatility for a 3-month option, and that for a 6-month option. Again, skew fixes the expiration date and considers vol across strike prices. Term structure fixes the strike price and considers different expiration dates. In the Black Scholes world, there is no differential in any of these implied volatility levels. If Apple is a 20 vol stock, then the implied vol is 20, no matter the strike or expiry date. The skew and the term structure are the market's way of saying, we like Black Scholes, but we know it's not perfect. Starting with the latter, we can glean some insight by examining a few instances in which the market assigns unique implied volatility levels based on expiration. Let's start with a simple observation in the world of single stocks. By and large, publicly listed U.S. corporations report earnings 4 times per year. These quarterly announcement days, unsurprisingly, often result in meaningful volatility in the reporting companies. In 2022, Meta fell by 26% on February 2nd as it announced its Q4 21 results. It plunged by 25% on October 26th of 2022 when its Q3 results were delivered to the market. And then on February 1st of this year, it surged by 23% as it announced its Q4 22 earnings. Those staggering moves are, of course, chosen to make a specific point, that with respect to volatility, earnings dates are uniquely important. Once a quarter, a company will generally experience a stock price fluctuation that can be multiples of the other roughly 248 trading days in the year. Now, option traders are a clever bunch. If you ask one of them to sell you a put option that expires the day after a company reports versus a day before it reports, she would not be indifferent. Sure, adding 2 days to the expiration nudges the option price incrementally higher, but especially for a stock like Meta, the burst of realized volatility on the earnings date is a nightmare for one with short option exposure. The delta hedge doesn't possibly hold up, and large losses are sure to result. The result of the recognition that earnings days are uniquely responsible for stock volatility is a glaring differential in the implied volatility of an option that expires before versus directly after the earnings date. Let's consider a few stats. In the case of Meta, starting in 2021, the absolute average of earnings day price moves is nearly 6.5 times that of non-earnings day price moves. This is a special case as we highlighted the massive moves experienced by this stock on recent earnings days. Let's look at Apple. Here we see that since 2021, earnings day volatility is 2.5 times that of volatility on non-earnings days. Let's take a look at an old economy stock like Colgate. How much surprise can there be in toothpaste sales? Well, it turns out at least a little, or perhaps it's Irish Spring Soap, Ajax, or Speed Stick, because earnings day moves have proven almost 3 times the size of non-earnings day moves since 2021. There's a simple explanation as to why implied volatility levels are not, as the Black Scholes model would suggest, consistent across every expiration. There are myriad other reasons as well, sometimes owing to liquidity differentials. For example, in the S&P, there is a dearth of supply of long-dated options, leading to a high clearing price for implied volatility with expirations past 5 years. But I want to comment on 2 other specific instances. The first is the macro version of a corporate earnings date. Think about how markets grapple with pricing options that expire before versus after a known macro catalyst, that is a date-certain event on the calendar. Think about non-farm payrolls or CPI or FOMC days. The market knows these events are coming. They're scheduled. And at different points in the risk cycle, these can become highly consequential. Using CPI as an example, over a 6-month period in 2022, the average absolute value of the move in the SPX on CPI days was 3%. This is roughly 2.7 times the average move on non-CPI days over that period. A similar premium occurred for FOMC days during this period as the market wrestled with what was coming from a policy change standpoint. And unsurprisingly, the market priced volatility with a significant premium over CPI and FOMC days. I like to call these earnings dates for the country. Utilizing the new one-day VIX, it's easy to see these days. The VIX1D was north of 46 the day before September's CPI release. It was at 47 the day before November's. Markets learn along the way. And as the tightening cycle has moved much further along and as the inflation threat has broadly receded, the risk premium has come down a great deal. We've seen similar pricing of index implied volatility around other dates of consequence. These can originate in the political realm sometimes. In 2016, both Brexit and the US election are ready examples where the market assigned a substantial risk premium ahead of these events. This, quote, calendar effect, as we'll call it, typically results in a hump in the implied volatility term structure. Think about a circumstance in which the market prices implied vol at 20 before the catalyst, at 30 directly after it, and then as the catalyst comprises a smaller component of the days to expiration, implied volatility trends back to the low 20s. On Bloomberg, you can hit Meta, Equity, OVDV, TRMS, Go, and see this hump right around the July 27th earnings release date. There's a second term structure configuration I want to talk about as well in calling out the holes in Black Scholes, and that's the inverted term structure. To picture this, contemplate an at-the-money term structure in the SPX where 1 month implied vol is 40, 3 month is 30, and 6 month is 25. The inverted term structure, like the inverted yield curve, does not appear that often. For both yield and volatility curves, the natural resting place is in contango, an upwardly sloping configuration. When a market experiences disruption, a vol curve can become inverted. In fact, it's a classic signal that something's gone wrong. In the Black Scholes world, there's not really the concept of disruption. Sure, the normal distribution contemplates large moves, but the market doesn't respond to them. If volatility is, quote, known and constant, then there's really no time variation in implied volatility. We know, of course, that in markets, the one constant is change itself. In business and financial conditions, in geopolitical risk, in technology, in valuations, and yes, in volatility also. Vol moves around for both micro and macro reasons. We previously discussed some component of the micro, the fluctuations that typically accompany a stock's earnings release. Macro vol is a thing too. In a broad market risk episode, a company's business prospects take a backseat to the deteriorating backdrop for the economy or credit conditions. Stocks become more correlated and volatile at the same time, a double whammy for portfolios that seek risk mitigation through diversification. Sentiment suffers. And when realized volatility spikes, investors find their risk-adjusted exposures much larger than they intended them to be. These episodes can force de-risking and also a rush to protect portfolios through options-based hedging. The demand for protection increases the price of all options. That is to say that the implied volatility surface rises across the term structure. But in a manner similar to how the Fed's actions on policy rates can lead to an inverted yield curve, a vol curve can become inverted as a result of short-dated option prices becoming especially elevated during a risk-off event. Why? Let's think about renting an umbrella on the precipice of a torrential downpour. If one sees the skies darkening, umbrellas are suddenly in demand, and rental prices are going up. But what about the relative price of rentals? Clearly, a 3-day rental will cost more than a 2-day rental, which in turn costs more than a single-day rental. But how much more? If I think this downpour is going to last 1 to 2 hours, why rent the umbrella for much longer than that? So what we might see is a cost of $5 for the first 2 hours and just an incremental $1 for the remainder of the day and another $1 after that. That's a good description of rental prices during a financial storm. Let's use the COVID market crash as an example of this. Up until February 1st of 2020, realized volatility on the SPX was tracking at 10 for the year. By April 1st, this same metric had exploded to 71%. In the process, the VIX, as mentioned, reached a new all-time high, surging to 82.69 on March 16th of 2020. If you are long equities during that awful period, the market moves are so violent that you'd pay nearly anything for a hedge. On that all-time high day in the VIX, 1 month implied volatility was 78, 3 month was 65, 6 month was 51, and 1 year was 32. Financial storms, like weather events, can do lasting damage, but they peak in intensity and then conditions begin normalizing. In markets, the inverted vol term structure speaks to the notion that, like the umbrella rental during the torrential downpour, short-dated insurance is in most demand. A realized volatility level of 70 is essentially impossible for the S&P to sustain. First, at some point, the de-risking process exhausts itself and the market stabilizes. The old adage, quote, "the cure for lower prices is lower prices," becomes relevant, especially in the context of the monetary and fiscal authorities who become very well invested in preventing a self-reinforcing spiral lower. Given this, it's no wonder that an investor would pay 78 vol for a 1-month option, but only 32 vol for a 1-year option. All right, so this is a little bit on the term structure part of the volatility surface. To review, Black Scholes does not contemplate a pricing configuration in which investors assign unique implied volatility levels to options of different expiration dates. We explored a little bit of why this actually does occur in the real world of markets, focusing on corporate earnings dates, important data releases like CPI, and then discussing episodes of extreme volatility that push short-dated implied vol levels up considerably, leading to inverted term structures. Now let's move on to the option strike skew. Remember, whereas in the term structure we fix the strike and compare implied vols of different expiries, the skew has us do the opposite. We fix the expiration date and compare the implied vol across the strike prices. The skew is a much talked about metric, and assessing it figures importantly in designing option trades. What do we typically observe in the skew? For broad equity indices like the S&P 500, we see that implied volatility is higher for out-of-the-money puts than it is for out-of-the-money calls. To provide some current context to this statement, a 3-month 10% out-of-the-money put on the SPX carries an implied vol of 21. By contrast, a 3-month 10% OTM call has a vol of just 11. For reference, 3-month at-the-money vol in the SPX is between these two numbers at 14. The 10 vol spread between the OTM put and call is not part of the theoretical world of Black Scholes. What's going on? Why does the market depart from Black Scholes? Here we go back to the foundational model assumption that stock returns are normally distributed. It's not a bad approximation, but experience tells us time and time again that markets exhibit fat tails. That is simply to say that if the returns of the SPX were actually normally distributed, and if we assume a volatility of around 20, the gigantic one-day moves that have indeed occurred a few times could simply not have occurred from a statistical standpoint. A favorite quote of mine comes from famous options academic, the late Mark Rubenstein. In reflecting on the 1987 stock market crash, Rubenstein said this: "Adherents of geometric Brownian motion or log normally distributed stock returns, must ever face a disturbing fact. Assuming the hypothesis that stock index returns are log normally distributed with about a 20% annualized volatility, the probability that the stock market could fall 29% in a single day is 10 to the minus 160. So improbable is such an event that it would not be anticipated to occur even if the stock market were to last for 20 billion years, the upper end of the currently estimated duration of the universe. Indeed, such an event should not occur even if the stock market were to enjoy a rebirth for 20 billion years in each of 20 billion big bangs. Let's put this a little differently, quoting head of food and beverage of the Tangiers Hotel, Sam Rothman, played wonderfully by Robert De Niro in the movie Casino. When pressing the slots manager about the odds of three $15,000 slot machine jackpots occurring in succession, Rothman screams, "It cannot happen. It would not happen." And while no single one-day move reaches that of October 19th, 1987, there are a bunch of other massive shocks. A 12% down move on March 16th of 2020, a 10% move lower on March 12th, three 9% plunges in late 2008. And with these surges in volatility come huge upswings as well. We had two 11% up days in late 2008 and two 9% up days in March of 2020. Markets can become entirely destabilized, and they generally crash down, not up. The strike skew reflects this empirical reality. One way I like to look at this is to differentiate the realized vol of the SPX on down days versus up days. In 2008, overall realized volatility was just north of 41%. That's an incredibly high number. When we slice this up, we see that vol on down days was 44% versus 38% on up days. How about during 1987? Overall realized vol was 33.7 for the year. Up-day vol was just 23.5, and vol on down days was a massive 43.4%. Here we gain an appreciation for how the market superimposes its own strike skew, overriding what Black Scholes would tell us to use. What's fascinating about the skew to me is its time variation. As mentioned, currently there is a 10 vol differential between the 3-month 10% out of the money put and 3-month 10% out of the money call. If we look at this same differential at the start of the year, the spread was only 7.5. These numbers are of great interest to derivative market participants because they translate directly into the cost of implementing specific trade structures. I've often told people that I can turn a 9-year-old or a 90-year-old into both option buyer or seller very easily, just through the price. That is to say that an insurance policy is a layup to buy at a sufficiently low price and an equally compelling thing to sell at a high enough price. Anyone can see it if the levels are outrageous enough. Understanding when the implied vol levels are either absurdly high or low translates into understanding when option prices are equally compelling to buy or sell. This happens very, very infrequently, but it is worth remembering that the VIX has been as low as 9 and as high as 83. Skew is not about the absolute level of implied volatility, but the relative level across strike prices. A simple question in this context is, would you buy the put or the put spread? If a stock was at 100 and you could buy the 90 strike put for 5 or the 90-80 put spread for 1, you are most probably going to go with the put spread. In this entirely made-up example, the market is paying you a really healthy vol skew to sell the 80 put and reduce your premium outlay. Sure, you get less, and the 90-80 put spread is not going to help you a ton in a true meltdown scenario, but you saved an awful lot of premium. For that same $5 outlay for the straight put, you could buy 5 times the number of 90-80 put spreads for $1. Seems compelling to me. So, the skew matters because it is a window into the cost of trade implementation. As mentioned, the skew on the SPX is one in which the OTM put vol exceeds the OTM call vol. That's been a thing since the 87 crash. The question becomes then, by how much? In 2022, the skew was incredibly flat. The put yielded a much smaller premium to the call than was the historical norm. Why? Well, there's a lot of debate around this, but for me, I see it as a response to what option traders experienced in 2022. This year was one in which SPX vol on up days actually exceeded the realized vol on down days. This almost never occurs. The result was a narrowing of OTM put and call vol. As this occurred, it made risk management vehicles like the collar strategy, comprised of a long put and short call, more economical than they'd been in 2 decades. I want to close out this discussion on skew and how the differential in implied volatility levels across strike prices responds to the behavior in the underlying asset by mentioning everyone's favorite stock, NVIDIA. A favorite quote of mine is from George Soros, who once said, "When I see a bubble forming, I rush in to buy, adding fuel to the fire." I think it's safe to say that neither Black nor Scholes contemplated such behavior in their model. I think it's also safe to say that the inclination suggested by Soros is a reality in markets. Call it greed, FOMO, or simply acknowledging that the pile-on effect in markets can be real. There are up crashes in securities as well. On May 25th, NVIDIA surged by 24%. It's now up almost 200% in 2023. Its realized vol on up days is 67.4%, and on down days, it's just 37.6%. That is a remarkable differential. So what's happened to the volatility skew in this stock as a result? At the end of 2022, the 3-month 10% OTM put vol was 5 higher than the 3-month 10% OTM call vol. Now, they're the same. The market has repriced the skew to reflect the increased propensity for large upshocks in the stock. With this incredibly flat skew, the economics of implementing a collar have gotten very interesting. For example, with NVIDIA at roughly 432, a stockholder could buy the September 390 put and nearly fully finance it by selling the September 500 call. That would leave the investor exposed to 42 points of downside, but having the chance of realizing 68 points of upside. Not a bad deal. I could go on and on about the vol surface, but my guess is you've probably had your fill already. Suffice it to say that the Black Scholes framework, like any other modeling construct, rests on the assumptions that approximate but don't match the real world. Markets are littered with frictions. They're not infinitely deep. And importantly, financial cycles result in plenty of variation over time in levels of implied volatility. Lastly, and perhaps most critically, asset returns are not actually governed by the normal distribution. Daily moves have proven to occur that are statistically inconceivable. Black Scholes becomes, then, a language to speak, but one in which communication among market participants requires a healthy dose of translation, with colloquialisms like term structure and skew introduced to facilitate the dialogue. Well, that's it for me. I appreciate you listening. Until next time, this is Dean Curnutt from the Alpha Exchange.